All right, so these planning considerations. What are the owners of this company thinking about? Let's go. That was our recap of last week. That was our kind of legal knowledge. So now we have to then go back to the business interests, and we have to think about what are some business concerns that they would have. What are the owners' interests in these entities, and how is that going to factor in to the sort of business side of the equation, right? We're on both sides here. We're both lawyers and business people for a minute. And we want to ask some questions. How does the form handle minority interests? Do minority shareholders have any rights? Do they have lots of rights? Do they have equal rights? In a partnership, person who gave the rake and person who gave the lawnmower, the 5% and the 95%, they have equal rights. In a corporation, the minority has certain duties owed by the majority. In the partnership, in the LP, the minority does not have those rights. An LLC does not have those rights. Does the minority care about those rights, and how does the form have those rights? Does anyone care? How does the form affect the ability to raise capital? As mentioned briefly, sole proprietorship, a general partnership may have more trouble raising capital than a corporation, because the corporation is going to be around. You can still get liability from the owner. The LLC is a little less well understood, so harder to raise equity capital, but only certain businesses, basically only high growth businesses get equity capital. So if it's a high growth startup kind of company, you need projections that say this is a $2 billion market. Like the companies that I showed you, right? The woman who's trying to revolutionize healthcare, home child care, it's a $2 billion market opportunity, right? You can invest $25,000 now, and it could be worth $300 million someday. That's the prospect that you need to have to get that kind of investment, because it's super risky to be an equity investor. Companies that are more like, I want to run a pizza shop, I want to start a bar, those are often going to be companies that need to get a loan and are just going to pay regular payments back. And by the way, I study crowdfunding. We don't talk about that here. It's new, but sort of another area where businesses in between can use crowdfunding to get some of this. And it doesn't seem like, from my research so far, crowdfunding investors don't seem to have any preference for corporations over LLCs. Maybe because they don't know the difference, although now you do. So you can check that out. So what do the owners want? The manner in which the interests are going to be handled is going to be a critical factor. So for example, in a general partnership, how does a general partnership deal with opportunistic behavior by the majority? What happens if you have two partners, you have three partners and two gang up on the third, right? The difference of opinion, or maybe the two are relatives, and you can see that kind of issue happening in a small business. What happens to the partnership? Well, the only real right that the minority partner has is to force a dissolution, or to, in Pennsylvania, to disassociate and demand those assets, which can be relatively difficult. I mean, you're going to, if your two partners don't agree with you and they're running the business in a different direction, you're going to have to disassociate, and then you're going to have to sue for an accounting. And so it's kind of hard to get minority rights in a partnership unless you craft a partnership agreement that sort of resolves that. In a corporation, generally the majority wins as well. I mean, you don't have a lot of rights as a minority shareholder in a corporation. You do have some duties. They can't totally take advantage of you. Like you can't sell majority shares at one price and minority shares at a lower price. All the shares have to be sold at the same price. So there are some protections and rules, but generally the corporation has the capital locked in, and then if you're a minority shareholder, you're going to have to live with management as well. So not a lot of rights there, probably less than a partnership. In a partnership, you can at least get your money out. Hard, but you can. And if you're a minority shareholder in a corporation, you better trust management, because there's probably no one to sell those shares to. Yeah. Interesting, because I am and I love the prenup example. I don't have the answer to that, because I actually have just started a research project on that question. And so what I've done is I've gotten a database of two-person startups. Two-person startups have this issue where they could easily disagree, and so the advice is not to form them. Right, and so first thing I want to do is regress the numbers on that and see if they actually do fail more often or not. And I'm working with someone on the West Coast, trying to get her involved and interested in this, because I don't have the time. But she wanted to do a research project with basically getting copies of their operating agreements and seeing if they had a provision for deadlock. It's sort of a way to deal with it in advance, right? And there's actually a concept called administrative contracting, which would support that notion, that there'd be some type of provision in advance for what happens when things go badly without resorting to the courts. So a formal mechanism, right, to resolve this, kind of like, now a prenup is a little bit more court-based, but the analogy is still there. If two people, but there are sometimes administrative procedures that you can go through to avoid getting to the legal remedy. And so I guess that's my long-winded way of saying I'm interested in the question. I don't know the answer. But my suspicion is that companies have found a way to deal with these sort of deadlock issues in advance. And if we could only get our hands on enough of these operating agreements and their bylaws and these shareholder agreements between 50-50 shareholders, my hypothesis is that we would find that they had some type of agreement in advance. And the advice is out there to do it that way, but my question really is it a legal prenup in the sense that if things go badly, we agree for a 50-50 split, or you keep the salt shaker or whatever, or is it more of an administrative provision where if we don't agree, we'll call our attorney, he'll flip a coin, and we'll do whatever he says and move forward, right? I actually tend to think that if we looked at all the literature that I've said has only the legal prenup concept, but I think if we looked at it, there'd probably be this administrative approach as well, where people have some kind of mechanism without resorting to the courts, without suing each other for resolving that. Like a binding arbitration, but I think something more informal, almost like moderated, or But the example that I was given about this, by the way, was where I started thinking about this was dealt with cost plus contracts. So it's not exactly this issue, but I might agree to sell you widgets. You might buy widgets from me, and then we might say, how much are you going to pay for them? We don't know how much widgets are going to cost because we don't know how much oil is going to be. So there's a lot of uncertainty. So maybe we agree that you'll pay 5% more than my cost, so I get some profit. That's called a cost plus agreement. And that sounds great on paper, right? Because that's really easy, right? And that if price I always make 5%. You decide to buy the widgets or not. You're not getting ripped off. There's a problem. The problem is, what if I'm inflating my cost? Right? There's lots of ways. What if my costs are high because I'm paying myself $1 million a year salary, and I add that to my cost? So we have this issue here, and a lot of cost plus contracts end up getting litigated because of this issue about unfairness. So we're seeing that some of these cost plus contracts have this mechanism that says basically every year on January 1st, an accounting firm is going to come in, review the books, and tell you what cost is. So that's an administrative mechanism, right? We're not actually going to sue about it. I mean, you could sue if you didn't allow the accounting firm in the door, but we've essentially appointed the administrator, the accounting firm, to come in, resolve the cost issue in advance of the problem, and make sure the problem doesn't happen. So it is formal, but it's not legal. And it might be something that we see in founder agreements too. All right. Why are people doing this? What are they trying to accomplish? Are they trying to raise money? Are they trying to start a huge, sweeping, growing startup firm? Or are they just trying to run a lifestyle business? Do they have the cash? So that sort of basis is going to really be informative as well. The advice that I usually give, if you're looking to raise outside money, you have to form a corporation. You have to form a corporation in order to attract significant amounts of outside capital. You should form a Delaware corporation. If you're a Pennsylvania company, you might think it's a good idea to form a Pennsylvania LLC. I'll enjoy tax benefits for a little while. If you plan on becoming a billion-dollar company, you're probably going to start by losing money. And if you're losing money, who cares about double taxation? There is no tax on losses. In fact, we'll talk about tax a little more in a minute, but corporations get to use those taxes, those losses in later years to offset their gains. So if you plan on raising a lot of, if you're going to lose money for a while, the benefit of being an LLC is really diminished. And if you need to raise outside capital, the conversion costs are there. Investors will still demand that you convert. Not all the time, but less and less, but still most of the time. So tax issues. Let's talk about the tax issues in specific. We'll talk about this double taxation. I'm going to show it to you. It does involve some math. I've tried to make the math as simple as possible. It follows what's in the book, so you can kind of refer back to it. But whether you have a corporation that makes an S election or a partnership or an LLC that's treated as a partnership, you have something called flow-through tax, meaning only the owners pay the tax. The company is not visible as a tax entity. It doesn't have to pay the IRS. And so that can help in many cases where there's profit, because otherwise the profit gets taxed when the corporation makes the profit, and then if those profits get distributed to the shareholders, they get taxed again on those dividends. And let me show you what that looks like from a simple scenario of there being gain or profit. So this is a really simple version of a balance sheet, or income statement rather. And this is our income statement, and we have a net income here of $80,000. And by the way, when you see parentheses, that's a negative, so this is a positive number. The business income here is $80,000. The numbers are in thousands. That's what the 000 means. Very brief how to read a balance statement for those of you who haven't seen it. 000 means we're going to put those 3 zeros after each number in the column. A loss is in parentheses. So here the company is making money. It's both paying people salaries, but what's different here is that third line item. You see that the business is going to pay a tax on that $80,000. So if the business is paying tax on that $80,000, it actually has left less afterwards to then dividend out. And so we deduct that corporate level taxation from the amount of money left in the account, and then we give the rest to the shareholders. Let's say they want to take all the profits for the year. Or in case of partners, all the partners, they're going to take their share. Well, since there was no tax at the partnership level, the entire $80 flows through. But in the case of the corporation, there was a tax at the corporate level, so that tax gets paid, and now $64.50 remains. And so the amount of income actually received in the case of a corporation is less. Now that does mean, of course, that the amount of tax each person pays on that income is less. If you receive $150,000, that's, by the way, that's profits plus salary, right? The owner here is paying themselves a salary of 70, as well as receiving 80 in the share, a total of 150. And so we're going to say that's a $13.50 tax. If a person actually only receives $134,500, they clearly pay less tax on that money than if they earned 150, right? Tax is a percentage basis. And so the personal tax is less, but again, you started with less money. When you add the two taxes together, the double tax, you really see how it hits here, and the corporation pays almost twice the amount of tax as the partnership in a situation where there is significant profits that are distributed to the shareholders. So this is the problem of double taxation. And we have a problem with taxation even if the company bears a loss. And so here's a loss scenario. And again, a loss is represented by those brackets around the income or loss. So the company here has lost $20, but again, the person is paid $70,000 in salary. And so the partnership, they both have losses. Personal income remains at 70, and the partnership is not taxed. So the person who receives the partner receives the loss. The loss passes through as well. So both profits and losses pass through, and so that loss actually reduces the taxable income of the partner. And so the partner, since the business lost $20,000 and the person made 70, their net gain is 50. 70 minus the 20, because the losses, the business does not see profit or loss. It goes through to the partner. And in this case, those losses pass through. Those losses are valuable. They offset taxable income. And so taxable income is decreased in the case of the partnership to $50,000. In the corporation, those losses stay with the corporation. Those losses, just like the profits, are at the corporate level. And so that personal income tax remains on the $70,000 salary. Those losses do not carry forward. And so in both the profit and the loss scenario, the corporation shareholder pays more tax than the partnership partner. And so there is a missing piece, however, which is that this is only a one-year balance sheet. As I mentioned, corporations can pass their losses forward and offset future gains. So the picture gets more complicated over a 5-year period. But we're not in tax class today, so I only need you to get to here, right? We're not taking the 5-year approach. This is the snapshot approach, the 1-year, one-time deal. And so if you can understand this chart, you can see how in both the situation where there is a gain, where there is a profit, that profit would be taxed twice, and so the corporation pays more on the corporate shareholder, ends up with less in their pocket at the end of the day. And even in a loss situation, because the losses also pass through the partnership but not the corporation, even in a loss scenario, the partner earns more than the business. So you might think, all right, let's always form a pass-through entity. Well, there's reasons not to do that, or reasons that you can avoid it. There are two major ways to avoid this double tax. And they're not always available. But if you can do it, you can have the simplicity and structure of a corporation, as well as the very reliable rules and law, and make an S election or zero out your income in order to avoid this double tax treatment and end up with the same scenario as a partnership, same tax scenario. So the two ways to do this are called zeroing out income, which I'll talk about second actually, and forming it as an S corporation and making an S election. Now, I'm actually oversimplifying. There are some differences between S corporations and partnerships with regard to tax. They're minor. This isn't tax class. You don't need to worry about the differences. We're going to talk about an S corporation as having the tax structure of a partnership. And that partnership side of the chart I just showed you, that's going to apply to S corporations for our simple purposes here. But just know, going out in the world, that S corporations and partnerships do have different tax rules, and tax is complicated. All right. But how do you make the election? Well, you can make an S election if the following things are true. And by the way, if any of them become not true at any point, the election is what's called blown. And so the conversion from an S corp to a C corp can happen at any time without you even realizing it, and you can have all this tax liability you didn't realize. So that's a real risk with an S corporation. It can be blown at any time. And it's hard to go the other way. To go from a C corp to an S corp, you have to deal with a lot of tax payments. So the IRS always gets its pound of flesh, one way or another, right? So they've figured out all the ways that people have needled around this. In any event, we're just talking about the formation decision. And at the formation stage, when can you make an S election? Well, you need it to be a domestic corporation or LLC, it has to be domestic with no more than 100 shareholders. 100 shareholders or less. You have 101 shareholders, the S election is blown. Now, in a small business, the ones that we're going to be looking at for the next couple days, we're not going to have 100 shareholders anytime soon, but this happens. This happened to Facebook. Not in the S election status, but Facebook hit a certain number of shareholders because it had several institutional shareholders. The shareholders began selling their shares, and so one shareholder, if you have 100 shares, you can sell them to 100 individuals. And so some of the large institutional shareholders, I think I mentioned it, Facebook. I said Facebook? Yes, Facebook. And Facebook went public before analysts thought it would, before it probably should have, and famously, it ended the IP. There was this whole craze of going public, and all these companies were going public, and people were making lots of money in 2011, 2012, and Facebook kind of killed that trend. Facebook went public and the stock price went down. It didn't get the IPO pop. Something went wrong in that transaction. And the speculation, which I think is right, is they went public before they wanted to because they had to make public disclosures because they hit a 500 shareholder limit. When you get enough shareholders and they have a number of shares of stock, especially if they have the ability to transfer their assets, they may sell their shares to multiple people. And if you have 99 shareholders, and you don't have a way to control them, that can easily become 100, 102, 104.